Hello everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predict gold prices. So in my last video I said that gold was ready for a breakout. Well, it hasn't broken out yet, so we are still here pushing against the 1750 level, and we have gone down a bit on apparently good news, which I will talk about later. And let's go to our data point. So the gold forecaster index is saying that in April we will see a push higher into gold in the next few months. So I'm still very comfortable here to hold gold at this point because our data point says that it will go higher. And this data point says the same. So let's go over the data. Let's talk about the leading index here. See, we don't even have a new data point on the leading index for the United States. They have stopped publishing it because of the COVID crisis. But you can see that the other indices are going down. The leading indicators are also going down. This weekly economic index, you can see that it's still very bad here. It's not getting higher, and that's May 30th. Leading indicators are down. Profits are down, and they will probably stay low. And the sum rule recession indicator says that we are clearly in a recession here. So these were the very nice numbers here, the non-farm payroll numbers. Everyone thought that we would have a negative number, but apparently jobs were added. And you can see that here. So this is the red line here. Instead of going down, we had a little tick up. Not a lot, but it was enough to push up the stock market. Also, the unemployment rate has gone a little bit up. Not a lot. We still have a lot to go to get back to the normal number here, which is probably here somewhere, and we are still here. Also, the red line still needs to go back into the positive. And this little blip here is the thing that we saw today. Let's see what we have here. Capacity utilization has crashed, as you can see here, is going to 65 here from 70. So you can see that inflation is actually very low here. You can see the correlation here. So we need to see some inflation later on to have a positive movement into the gold price. And we don't see that yet. We will monitor it. Now let's take a look at the money supply. And here I see a little bit of a problem. We had here a nice rise in the money supply, but at some point here, from May onwards, the rise is actually flattening out here. So probably a lot of people are now paying back their debt, their credit cards. So this rise is not going higher, and also the Federal Reserve is not printing money anymore. So they have stopped increasing their balance sheet. So that's a bit of a problem here. And that's why gold prices are not going higher. Another indicator for the inflation rate is the producer price index. can see that this is also going down. So this is also not good for inflation. We will see probably deflation here. And yeah, this is not looking good here. Personal consumption expenditures are down, which will pull down the CPI with it. But there are also other signs. You can also see here that real output is going down. So we are not producing anymore. This is a minus sign. So this is going down, and that means that inflation should be coming back here. If you don't produce, then inflation will soar. Let's take a look at the central bank balance sheets. We see that the Federal Reserve has decreased its purchases here. So first it printed a lot of money and now it's flattening out. The ECB has started to print money as well. So that's the blue line. It's going up steadily. And then we have Japan, which is the green line. So I'm not seeing a lot of money printing anymore. So that's probably not as positive for gold here. You can see here also the treasuries here. Treasuries are being bought, but at a low pace. Even this year, the mortgages, the red line, are even going down. So the asset purchases have stopped. Let's take a look at the repurchase agreements. We see a little uptick here. And the repos, you can see here a pretty big rise here in repo operations. And this is actually something very interesting because everyone has stopped looking at this, but I think they should start looking back at this because we haven't seen such a rise since the start of the repo crisis. So this is a pretty high data point here. These are the overnight repurchase agreements. Actually, a very big spike here. So I need to look into that. Okay, we also got the trade balance numbers. So we got a huge trade deficit number for the month of April. That's this data point. So we went here, from here, back to here. So that's a huge drop, a very large deficit point. And if you look at the US dollar here, the trade weighted US dollar, this is correlated. So I expect that this drop will correlate with the drop of the US dollar to probably the 90 level here. So we started at 100 and now it should go to 90. It's now at 96, so I think we will see another drop in the dollar. And here you can also see that there are a lot of budget deficits, and this will also add to the crash in the dollar. I think we will see that very soon, and that would be positive for gold. The ECB recently also doubled the size of its QE to 1.35 trillion, so that's also positive. So you can see that the monetary base, which is 20 trillion, will be added with 1.35 trillion over the coming year. Okay, we also got numbers from trading economics, and we got the gold reserves per country. So I've listed them all here in this list here. So we got numbers from March from this year, and you can see that Russia has bought gold. India has also added 30 tons. Turkey has bought 100 tons. Kazakhstan bought some. Australia has bought some. The UAE keeps on buying. Mongolia, Ecuador, and we only had 3 countries that sold some gold, but not a lot. Only Sri Lanka has sold more than 10 tons of gold. So we can see that central banks are still buying gold at this point. Um, Also something about oil. I think that oil demand is coming back. You can see that here. Consumption should bounce back here, and the production should decline here. So we could see here a gap, a demand gap to supply here, which could push up oil prices until the end of this year. And that's what we're seeing now. Oil is going up, so I think everyone should be looking at oil companies, oil producers. Now, I also want to talk about this thing here, which is actually very important to know. So I think when you look at this, this is a balance sheet of a company. For example, American Airlines, it has assets, cash, and then on the liability side, we have debt and equity. And this company, for example, is not making money. So what does the Fed do? They inject liquidity. So they add debt to the company. So the debt increases and they get cash because they were illiquid first. So that's what happens. We have more cash and more debt. The asset side and the equity side stays the same. So the Fed can inject liquidity, but that doesn't mean that the company is earning more money. So they are still losing money. That means that the cash goes down together with the equity. So this goes down, the equity goes to zero, and that means that the company becomes insolvent because it doesn't have any equity left. So this is actually what we are going to see later on if these companies cannot earn cash flow. If they have no earnings, then eventually equity will go to zero. That's what will happen. And that also means that the market cap will go to the equity value, which is zero. So stocks should be going down when a company doesn't have any earnings. That's what is visible here. So let's see if the Fed can keep pushing up these companies, and because I think that this is not possible if earnings don't go up. And we see here that earnings aren't going up. See, the PE ratio is going up. That means that the valuations go up, but the earnings are not going higher. You can see here, for example, the earnings, and these earnings will be going down. This is the forecast. So they can try to push up the stock market, but I think it won't work if these earnings keep going down, of course. There could be an economic recovery where the forward earnings go back up, and that would, of course, push up the stock market. But at this moment here, in time, I see the earnings still going down. And what will happen is that people will not invest in stocks anymore because of these high valuations. Actually, it's now at 24 somewhere here instead of 20. We're in June already, so it's now even more overvalued. So what will they do? They will not go into stocks anymore, so they will go into things like gold, food, oil, airplane tickets. These are consumer goods. And that's what we are seeing now. You can see here, for example, that food inflation is going higher because they cannot invest in stocks anymore. They are completely overvalued. Now, I think stocks are now at 2% dividend yield. Can actually check this here. Let's say you can click on this, for example. So here you can see that dividend yields should be compared to the bond yield. And currently we have a bond yield of 0.9. So it went up a bit. This is from May, and we had a huge rise here to 0.9%. And the dividend yield currently is, let's take a look. So these are the dividend yields of June the 5th. And you can see here that the dividend yield is currently at 2%. So we have a bond yield of 0.9% and a dividend of 2%. So that means that stocks are still undervalued compared to bonds. But when these bond yields go higher, go above 1% to 2%, then suddenly stocks will be overvalued. If bond yields go to 3%, then you should sell your stocks because then these stocks are completely overvalued and their dividends will only give you 2%. So whenever the bond yield goes above 2%, you need to sell your stocks. So that's what we're seeing now. We see that bonds are still here at 1% and stocks are at 2% yield. So stocks will still give a lot of yield to you. So that's why people are buying these stocks, and that means that the stock market can go higher. So this red line will go higher, maybe even until here, while the bond yields will also go higher, above 1%, and they will meet each other somewhere here. So I guess that stocks can still move higher here until they go above their all-time high here, and then they will meet each other with the bond yields. So we need to keep a close eye on this because that's very important to know. I also wanted to talk about my 5 crystal balls. So you can see here, these are my 5 crystal balls. The gold forecaster index is the first that I created. I also have the oil forecaster index. So this is a chart that will predict the oil price, and it works like a charm. When we look at the latest data here, you can see that it's very correlated, and the latest data point is that it's going up, and that's what it's doing now. Let's take a look at the stock forecaster index. This is based on Fed balance sheet, credit spreads, jobless claims, and it's also looking very predictable here. It's a very nice crystal ball. Look at this. Look at this. This is the blue line that I created. This is the oil forecaster index, and the green line are stocks. So we can clearly see that this is predicting that stocks are going higher. We are even going above the zero line now, so stocks are really a buy now. So we will see stocks go higher. We also have the bond forecaster index. This is based on GDP, balance sheet, Treasury yields, and this is also a very nice chart. So the blue line here predicts the bond yield. If it goes below zero, then bond yields will go down. If it goes higher, then bond yields go up. And lately, we see that the blue line is going straight up here. So I expect that bond yields will keep going higher until probably 1.2%, 1.4%. And this is where the bond yields will intersect with the dividend yields as stocks rise. Stocks are now at 2%, and as they rise, the dividend yield will go down. So the intersection will be at 1.6 somewhere here, and then something interesting will happen. We also have the US dollar forecasted, and that's the fifth crystal ball. Also very useful to predict what the US dollar is going to do. So the red line is the predictor. So here you can see that the red line is going higher. That means that the dollar went up from here to here. In February and March, we saw a huge spike in the dollar. And actually, we see that this red line is still very high. So the dollar could probably stay at this level. It's not going to crash, but well, you had a weakening red line here, but it's gone back up. But of course, this is a number from February, and we're already in June now, so this is very delayed. But this will give you some sort of feeling of where the trend is going. The trend is going higher in the dollar, but it could be going down now because of all the deficits spending and all the trade deficits that we have. Okay, so the conclusion is I wouldn't be too worried about the gold price going down today. It just went down to here, 1680. It'll probably go back higher. We have a huge resistance here at 1800. So yeah, if there's a high resistance, we could get small bounces back to the downside, and then we will probably push higher into the end of the year. So I would keep stacking, and I'll see you in the next video.